So, hello friends, welcome to my channel, the main coaching center. And so, today I'm going to explain your chartered accounts, another chapter in accounting, chartered accounts, an introduction, another chapter that is accounting as a measurement discipline, valuation principles, accounting estimates. So, in last videos, I explained you 4 chapters of chartered accounts. This is the 5th chapter of chartered accounts, and that is also an introduction. First part, that is an introduction. In that, this is the 5th chapter. Still many parts are there. So here, meaning, let us come to the first topics of your chapter: the accounting as a measurement disciplines, valuation principles, accounting estimates. So meaning of measurement. So measurement is a vital aspect of accounting. So it is a vital aspect of accounting. It's an important aspect. Primarily, transaction and events are measured in terms of money. You measure the transaction and events in the terms of money. Any measurement discipline deals with 3 basic elements in the measurement. 3 basic elements, that is identification of the object and events to be measured, identification of that object what you are measuring, and event what is happened to events what are done in the to be measured, what events it has done to measure, and selection of standard, which selection of the standard, accounting standards. In last chapter you learned in that which standard you have to put that account, put that term, what they have, you have put that object or the thing, money or scale to be used, or to which thing you have to put. Next, evaluation of dimension or measurement of standard or scale. So evaluation of the dimensions of measurement of that standards, what your standards are putting, measuring what your how much amounts they have given, or scale how much you have done. So Professor R.J. Chambers, who has defined the measurement. So Professor R.J. Chambers, if they ask for 1 marks, you have to say Professor R.J. Chambers, who has defined the measurement. So as per Professor R.J. Chambers, assignment of numbers to object and events according to the rules. Events are planning according to the rules, it is specifying the property to be measured. It is telling us the property, how much property to be measured, and the scale, and what scale, on which length, which amount you have to measure, and what scale it has to be used, and the dimension of that unit. What is the dimension of that unit? So R.J. Chamber, who was an accounting, evaluation and economic behavior Prentice Hall, include Clef NG. He was born in R.J. Chamber was born in Prentice Hall, Englewood Cliffs, NG in 1966. R.J. Chambers was born. So Kehler, and another person whose name is Kehler, he defined that measurement is the assignment of system of ordinary and cardinal numbers. So measurement of the some ordinary numbers and many more numbers, cardinal numbers, to the result of the scheme of inquiry, to result what we get for that inquiry, or apparatus of observation, to for their observation with accordance to their logical or mathematical, with accordance to their number logical or mathematical rules. We have to measure according to their Kohler's, according to another person. Kohler says like the measurement like this. Ordinary numbers or ordinals. So ordinary numbers, they are the numbers that are used to denote the position of the ordinary sequence, first, second, third, fourth, fifth. These are the ordinary numbers here. Ordinary numbers, Euler said no that. And whereas the cardinal numbers, ordinary numbers or cardinal numbers, Euler said to measure the for the measurement. So cardinal number is how many there are, 1, 2, 3, 4, etc. How many there are, how many that numbers, like that numbers are there, like 1, 2, 3, 4. Here you are telling first, third, second, fourth, but here 1, 2, 3, 4 you are telling in cardinal number. Okay, so this was the difference between ordinal and cardinal number. Next, chambers. So R.J. Chambers there you learned. So according to his definition, it has been widely used to judge how far accounting can be treated as the measurement of discipline, how far you can treat accounting as the measurement of discipline. For this, according to the R.J. Chambers definition, there are three elements for measurement of accounting. The first element that by using which you can measure the accounting is identification of the object and events be measured. This way here only you learnt here only you learnt identification of the object and measuring the and identification of the object and events to be measured. Next is selection of standards or scale to be used. Third one is evaluation of dimension of measurement standard or scale. Here only you learnt in starting only I said what are the measurement and how you can deal. There are three basic elements of measurement. So these three basic element was explained by the Chambers. R.J. Chambers explained these three basic elements. Next, let us come to the next topic. After this, so here elements of measurement, it is like a chart view. So now you have clearly defined about accounting. It is the process of identifying, measuring, communicating economical information so that we can to permit an informed judgment and decision by the users of that information. So accounting, it has essentially includes the measurement of information. What information you get, how much you get information, on that only accounting depends. So decision makers, they all need past, present and future information. What past, what happened, how much was our last year's performance, how was our last year's performance, and how present year's performance is going on, and how it may be. By using past and present, you may decide about the future. Will it will our in future will get profit, our company will go at growth or not. For that, the past and present you have to check how much you are getting, how your company is in which position, in financial which position, for future information. So these all for decision maker, for making the decisions, the decision maker, whether it may be manager, he needs all the information of past, present and future. Next, for external users, generally the past information is communicated. For external users, you give only past information. In past, what was your position of your company, that information you will give for the external users. So there is no uniform set of events and transaction in accounting. There is not a uniform sets of event transactions happening in the accounting that are required for decision making. There are no uniform events and transactions that are needed for in accounting which are may need for taking decision making. For example, in cash management, various cash receipts and expenses are the necessary objects and events. In cash management, various cash receipts and expenses you need for making decision in the events. Next, obviously the decision makers also need the past cash receipts and expenses data along with the projected receipts and expenses, along with the now expenses. They need past cash receipt and expenses. For giving loan to business, their business, one needs information regarding to their repayment ability. The bank, if they want to know if they want to give you a loan, they need to know about your repayment ability. If your company goes in loss, how will you pay the loan of the bank? That repayment ability the bank wants to know. And it is called one of the principles and interest they call. And this also includes the bank they also need some of the past information, current status, affairs as well as future projections for your company, whatever your ideas they all know. And past, if you are opening another branch, you have one branch of company, you want another branch of company, for that you will, if you take loan, for that if they want to know your present company that you have here, there's its past, present and future projection, what will be there, what will happen, will it is give profit or loss. So it may be mentioned that the past and present objectives and events can be measured with some of the degrees of accuracy. With some of the degrees of accuracy, you can measure the past and present. But future events and objectives are not predicted. So it is or only predicted. Sorry, it is only predicted. The future and the future events and objects are just it is predicted. You cannot measure. You cannot say yes, I will get profit. This much money only I will get profit. You cannot say. But past and present you can say, because past you know already. You did last year's financial statement, balance sheet you have done, accounting you have done, and you have given information to your managers, your head. They will tell and you have stored it. You will, as you know, every balance sheet of a company should be stored, so that because they will know about it, it may help them to know about their future, what will happen in the future for that company. But in future you cannot say about that you cannot measure this much amount will gain. So you can only just predict, yes, we will get profit or loss by seeing the past and present situation of your company. So prediction is an essential. So prediction is an very important part in accounting information. Decision makers have to take decision. Decision makers have to take decision about the unseen future, for which they need some suitable. For which the decision makers need some of the suitable information for taking some of the unseen measures for unseen future. For taking some of the correct decisions in unseen future, they need some of the information. Next, in an accounting, money is the scale of measurement. So in an accounting, you measure what the company has got profit or not. You measure it through money only. And although nowadays quantity information is also communicated, quantity of information is communicated along with the monetary information. Along with the monetary information, more quantity information is communicated nowadays. Money is a measurement scale that has no universal denomination. Money is a measurement scale. Whole universe follows it. It has some of the different currency in different countries. In India it is rupees, UK it may be pounds, pound, and in Germany it may be Deutschmark, United States dollar. Anyway, but also there is no constant exchange relationship among the currency. There is no constant. You will not do exchange of money every year, every day. No. There may be every year, but there will be not every day, every week. You will not do exchange of money from other country. So let us take, if one businessman in India took a loan of $5,000 from a business of USA, from a businessman of the USA, they had taken $5,000 rupees. So he would enter the transaction in the book in the terms of money only. He will enter that amount. Suppose at the time of loan agreement the exchange rate US dollar is rupees 50, then the loan amounted to be is the loan our loan, that is the $5,000. It should be written in the Indian rupees. That will come around 2,550,000, and afterwards the exchange rate has been changed. It has increased to $1. That is $1 is equal to rupees 55 in Indian currency. At the exchange rate, the loan amount also increases. Loan amount also increases to 2,75,000, because $1 he has put as exchange rate 55 rupees. So loan amount also increases 250 into little bit 5 rupees extra, like that. So it will be exchange. So money as it is a unit of measurement that has universal applicability across the boundaries of a country, unless a common currency is in vogue. It is in rule. See, the next topic is dimension of measurement scale. And An ideal measurement scale should be stable over time. So the measurement scale should be stable for over a time. For example, if one buys 1 kg of cabbage, today if a person buys 1 kg of cabbage, the quantity he receives will be the same. If he will buy 1 kg cabbage 1 year later, similarly the length of 1 meter cloth will not be. So, for example, is what means if you bring 1 kg of cabbage in today, the rate what will be like 30 rupees or 40 rupees. It's simple you take. So the quantity he receives will be same after 1 year also it will be 1 kg he receives. But there will be change in rate. It may go to 40, 50 according to their rate in that country, how much it is going on. According to their rate. According to the rate in that country means they are exporting the products or importing what happening on that the rate belongs. Similarly, the length of 1 meter cloth will not change if he bought a few days later, but 1 meter cloth it will not change. It will change for year, 1 year or more than years. The rate of cloth will not change. That is to say that a measurement scale should be stable in dimension. A measurement scale should be stable in some of the dimension, like 1 year, it will not change and like that. So money, it is a scale of measurement that is not stable. That is money, it is measurement, it is a scale of measurement, but it is not stable. There occurs continuous change in the input and output of prices. Input and output of prices, there will be continuous changes, and the same quantity of money may not have the ability to buy some quantity of essential goods at different dates. So the same quantity you have some money that will be not, that may not have the ability, that is not enough to buy the same quantity of goods that you have buy it in last year. That goods you cannot buy this year because you do not have the money, because there will be increase of money. But as you have money same, that you that much money only, that the money you was having last year. See, you were having 1 lakh in last year. Now also you have 1 lakh. That time it was 1 lakh only, but now it has increased because there will be change in money, change in amount. So thus information of 1 year measured in money terms may not be comparable with another year. So information, see, 1 lakh here, 1 lakh not, it has increased. You need more money to buy that goods. Suppose, see, year 1 5,000 packets, 5 lakh. Here quantity 4,500 packets, but here in year 2 he has brought the quantity is less, 4,500 packets, but it is increased. It is increased 5 lakh 40,000. It has the rate has come, but because here the money will be changed or the price will be increased for that product. Looking at the monetary figures, one may be glad for 8% sales growth. In fact, there was 10% production of and sales declines. So the growth, what he does, he got loss. So what he will do, he will sell it, but for more money. See, for year 1 it was 5,000 packets, it was 4,000. But in year 2 quantity was 4,500 packets, but he got 4,500. Here, see here, 4,500 packets. 500 is less than first year, but money is 50,000 more than first year. Like that only it will be changing. So tax growth profit, how we will see, means sales minus cost production. So then in the first year of profit was 1 lakh, while in the second year the profit was 90,000. Then there was 10% decline in gross profit. Decline means 10% less in the gross profit than last year. So money as a unit of measurement, is not stable in the dimension. It's not stable in every dimension. It will change in a dimensionally. It will be keep changing in its dimensionally. Next, accounting as a measurement discipline. So how do you measure the transaction or an event? How you will measure? Unless there is no measurement base, there is no base to, means you don't know how to measure that, then how you will measure? It is impossible. So that's why you have started for, so measurement base is settled. So we cannot progress
forward we cannot go till you have record keeping function or bookkeeping function, because here there only will have every information of every transaction. Without that we will have nothing, no information. So it has been explained that accounting is meant for generating information. Accounting is meant for giving information. Every day, day to day, you will giving information for your managers. This much transaction has happened, this much we have earned, and it will help them to take a decision also. But generation of such information, preparing of such information, it is made by recording, classification, summarizing data. By this, it is this information we have got. By that process, it measures some of the performance of the business entity in the way of profit or loss. It will show in the financial position. It will show you the financial position, whether your company is going profit or loss, your company is getting profit or loss. Thus, measurement is an important part in the accounting discipline. But a set of theorems is called in the measurement subsystems. They are for the measurement. They have some of the theorems. These theorems should be carefully understood to know how the cogs of accounting will work, how accounting work. For that you have to know this theorem correctly. Nowadays accounting profession are make they have three theorem, namely consistency and accrual as fundamental accounting assumption, and these assumptions are taken as granted, and also while they are measuring, classifying, summarizing, also presenting various policies, they are adopted. So recording, summarizing and communication of information are also some of the important part of accounting, but which we do not fall within the which does not come in the measurement of discipline topic, but it is important for accounting. It is the explanation of the accounting, definition of the accounting. Therefore, we cannot simply say that accounting is a measurement discipline. We cannot just say. We not only if we say how anyone can understand it. So that's why in accounting is the unit of measurement, So let us take some of the things that are granted, that all transaction and events to be recorded in the terms of money only. Quantity information is also required in many cases, but such information is only supplementary to monetary information. Next is valuation principle, the first principle. There are four generally accepted measurement bases or valuation principle. Therefore, the first one is historical cost. So it means that acquisition price. For example, a businessman paid 7 lakhs for the purchase of machines, and he acquired price. It includes installation charge rupees 8 lakhs, but the machine cost was 7 lakh. So it is extra price. So according to this, the historical cost, according to this, assets are recorded at an amount of cash. Or it is recorded as cash equivalent paid, or the fair value of the assets of the time of acquisition. Liabilities are recorded as the amount of proceed received in exchange for their obligation. In some circumstances, a liability, they'll record liability at the amount of cash or cash equivalents expected to be paid for satisfying their normal course of business. So, take an example. Mr. X, a businessman, he takes 5 lakhs loan from a bank at 10% interest per annum per year. It is to be recorded at the amount of proceeded received in exchange for the obligation. Here the obligation repayment of loan as well as payment interest agreed rate is 10%. Proceedingly he received rupees 5 lakh. It is historical cost of transaction. Then he take another case regarding the payment for their income tax liability. So every individual has to pay income tax, but the income tax liability is not settled immediately. When one earns his income, it is not settled. Income tax authority settle it some time later also, which is technically called as assessment year. As per historical cost base, so he should pay more money here. 5 lakh, he should pay more money because 5 lakh is historical cost, means he has taken. But 10% interest all he should add, and he should pay how much the bank says. So there are the valuation principles is of 4 types: historical cost, current cost, realizable value, present value. Now you learned about the historical cost. Now let us learn about the current cost. So in current cost, let us go straightly to the example first. So Mr. X, he purchased a machinery in 1st January 2000 at the rupees of 7 lakh. As per historical cost, in 7 lakh is only the rupees, the acquisition rupees. As per 1/1/2011, Mr. X found that it was costed 25 lakh. What he has purchased machine, it was 25 lakh to purchase that machine. So take also Mr. X took the loan from the bank on rupees on 1/1/2000 for rupees 5 lakh. He took loan, and at the rate of 18% per annum he will be repayable at the end of 15th year with the interest what they have given. So as is in 1/1/2011, the bank announces 1% repayments penalty on the loan. Repayment penalty, penalty on the loan on the amount if it is paid within 15 days starting from the day. If it is paid within 15 days, that penalty. As per historical cost, the liability it is recorded as 1 lakh. 5 lakh it is recorded. But according to there, the assets is recorded as 7 lakh because he has to pay the loan. Means he has to pay 5 lakh loan plus interest what the bank has kept. So 2 lakh interest. So total it is 7 lakh. So the current cost gives an alternative measurement base. So it is an alternative measurement base. Assets, it has carried out the amount of cash. Assets are the amount of cash equivalent through which that would have to be paid. And if the same or an equivalent asset but currently liabilities are carried at the discounted amount of cash and equivalents that would be required to settle the obligation current. So as per current cost base, the machine value was 25 lakh, which will be the value of the bank loan is 5 lakh 5,000. Value of bank loan is 5 lakh 5,000. So as per current cost base, this is the answer, current cost base. Next is realizable value. Now another example open for realizable value is, see, Mr. X, he found that he can get 20 lakhs if he would sell his machine that he was purchased on 1/1/2000, paying 7 lakh, and which would cost 25 lakh in case he would buy it currently. Current rate is it's 25 lakh, but at that time it was 20 lakh. So take also that Mr. X found that he had no money to pay off to bank loan, that is 5 lakh currently. So he had no money to pay for the bank loan as he took 5 lakh bank loan. As per realizable value, the assets are carried as the amount of cash or cash element that could currently be obtained, this the amount the asset can be obtained by selling an asset. Here the asset he has is 20 lakhs. That machine, if he sells he will get 25 lakh. So after disposal may yield something less. So liabilities are carried at their settlement value. At their settlement values, liabilities are carried, and the undiscontinued amount of cash or cash element expressed to be paid to satisfy the liability in the normal course of business. So the machine that should be recorded at 20 lakh rupees in the realizable value in the ordinary sale, while the bank loan should be 5 lakh. The settlement value in the normal course of the business, it is equal settlement value. Next is present value. See another example. Suppose take on 1/1/2011, take it as time of for reference. Now think the machine purchased by Mr. X is in 1/1/2001 can work for another 10 years and is supposed to generate, it may give a cash at the rate rupees 1 lakh per annum. So and also take the bank loan 5 lakh taken by Mr. X is to be repaid on 2015 year to repay. Annual interest is rupees 90,000. It is annual interest. So as per this present value, an asset that is carried out as at the present is discontinued and discounted value of the future. It is discounted value of the future net cash inflow, and the item is expected to generate. The item is expected to generate, and liability are carried at the liability is carried at the present discounted value of future net cash outflow. The term discount cash flow cash outlet needs a little elaboration. See, rupees 100 on hand in 1/1/2001 is not equivalent to rupees 100 that was in hand in 31/12/2011. He will be not having 100 rupees only in hand during the end of the year. So there is a time gap of 1 year. There is a time gap of 1 year. If Mr. X has rupees 100 on 1/1/2011 and he could use it at that time. At that time 1 year he could use it. If he received it only on 31/1, he had sacrificed his use for a year. So he has sacrificed his use for a year because that money he could use for himself only. The value of the sacrifice is called as time value of money. The value of sacrificing or giving that money is called as time value of that money. So Mr. X would sacrifice. He would agree to take money on 31/12/2011 if he had compensation. If he had compensation for that sacrifice, he would accept to take the money. So a rational man will never exchange rupees 100 as uh, one and will with the rupees 100 he has received in that one. Then he will get 100 rupees in 1/1/2001 is not equivalent to rupees 100. It is not equal to rupees 100. He what he in 31/12/2011 to make the money receivable at the future date equal with the money of the present date. It is to devaluate it. Such devaluation is called as the discounting of future money. Perhaps you know that the compound interest rule A is equal to P bracket 1 plus I bracket to the power n. So here in this compound interest rule, A is equal to amount, P is equal to principal, I is interest by 100, n is equal to time. So this equation that tells you about the relation between the present money relationship, principals and their future money amount, how it may be. So if I and n are given to find out P they are given, and a equation is to be changed slightly. The equation is changed slightly. Using the equation, one can find out the present value if he knows the value of A. I and n, if he knows present value amount what you get, interest and time what you have given, if he knows this he can find present value. Suppose I is equal to 20%. Now what is the present value of rupees 1 lakh that he has received in 31/12/2011? So present value P is equal to 1 lakh, and in that 1 plus 2, 1 plus, that is I is 2. I is equal to 2, 20% means 2, and n is equal to 1. So therefore it will be 83,000. P is equal to 83,300. So the time of receipt, let us take 31/12/2012. It was money value is 1 lakh only. For whole 10 years it is 1 lakh only. Present value he had got is 83,000 minus 83,000. So the present value is 69,441 because he has minus it. So here amount is, so amount what you have to take, 1 lakh minus here present value is 83,000. So 83,000 into 1 plus 2 you have to do 1 plus 2 into 1. If you do this and if you substitute, you will get 69,000, like that only here. So the total of all these present values is rupees 4,19,246. Since the machine purchased, these all become 4,19,240. Since the machine purchased, Mr. X will be cash value is 4,19,246 in the terms of present value. So it is to be valued at such amount as per present value measurement basis. So here Mr. X will be receive 1 lakh at different points in the time. These are cash inflow. So perhaps you can also know the annuity rule. So the same rule, so here in this again annuity rule. So here, this is same page only. So perhaps it is annuity rule. So present value of an annuity or RE also we say. So A for n period is A is equal to annuity, I is equal to interest, T is equal to time 1, 2, 3, n any amount of time. So A by I bracket 1 minus 1 by bracket 1 plus I bracket to the power n. A is 1 lakh, I is 0.20. So 1 minus 1 minus 1 by 1 bracket 1 plus 0.20 into the power 10, because here they are applying the rule to derive the present value is 1 lakh and 10 years, and for 10 years you are applying it. N is equal to time is n is 10 years and 0.20 is the interest, because 20 at the rate of 20%. So 1 lakh into 20% in 10 years, so 0.20 will get. So therefore 4,19,246 is the amount. Similarly, the present value of the bank loan is, you have to take is 90,000 is the present value of 0.20 is the interest only, and same, everything is same. So therefore when you do it, you will get plus you will get 5 lakh as the interest, and same 5 lakh you have to take, and for 5 years you are taking it. So in the other case, so therefore it will be 2,69,155 in one side plus 2,939. So therefore 4,70,094. Thus we get the 4 measurements. Historical cost for machine is 7 lakh here, and liability is 5 lakh. Current cost for machine is 25 lakh, but liability is 4,50,000. Realizable cost is for machine is 20,000 and liability is 5 lakh, and machine for machine is we get 4,19,000, but here bank loan is more 4,70,000. Like this you have to measure this rule, this equation you have to use, and then another equation in there I showed no. So according to the what question they give, you have to choose what will be the amount, what will be the interest, what will be the time. Next, measurement and valuation. So value, it relates to the benefits to be derived from objects. Benefit that should be derived from the objects, abilities or ideas. What are the benefits you should be derived from there? To the economist, value is the utility. To the economist, for economist, the value is the utility of an economic resource. It is utility to the person contemplating or enjoying. A person contemplating or enjoying its users, enjoying their users. In accounting, to mean value on an object, abilities or ideas, so a monetary surrogate is used. So this is to say the value is measured in terms of money. The value that you get, it is measured in terms of money. And if an individual purchases a car, see if an individual he purchases a car by paying a rupees of 2,50,000. So its value, it lies in satisfaction to be derived by the individual who using that car in future. He is using that car. So economists often use ordinary scales. They use to indicate this level of satisfaction. For level of satisfaction, they use ordinary scale, but accountants use only cardinal scales. So the cardinal scales, in starting you learned ordinary and cardinal scales, but the accountants use cardinal scale. If the value of car is taken as 2,50,000, then it is only one type of value called acquisition cost or historical cost. So value is indicated by measurement. In accounting, the value is always measured in the terms of money, as you know. Accounting estimates. Earlier in these units we have learned how to measure the transaction. We have learned which had already taken place and for which either some value money has been paid or some valuation principles are to be adopted for their measurement. For this, what you have to measure, but there are certain items, but there are certain things which are not occurred. So which are not happened, therefore cannot be measured. They cannot be measured using valuation principle. You cannot measure that because it has not happened only. Still they are necessary to be recorded in the book of accounts. They are very much important. They are not happened, but still they are very much important to record. For example, provision for doubtful debts. For such items we need some values. For provision of doubtful debts, for such items you need some of the values. In such a situation, reasonable estimates that are based on the existing situation and past experiences, they are made. And the measurement of some of the certain assets and liabilities, they are based on estimates of uncertain future events. Uncertain future events. As a result of the uncertain inherent in business activities, many financial statements items cannot be measured. Things cannot be measured with the precision, but can only be estimated. They cannot be measured with the precision, their amount, but they can be estimated. Therefore, the management makes preparation for their makes various estimates, various assumption of assets, liabilities, income, expenses on the date of preparation of their financial statement. They make this assumption. Such estimates are made in connection with the computation of depreciation. Estimates are made for connection with their computation of depreciation, amortization, impairment losses, as well as accruals, provisions, employee benefits obligation, for many other things. Also, estimate may be required in determining. They may help in determining the bad debts, useful life, and residual value of an item of plants and machineries and inventory obsolescence. The process of estimation that involves the judgment based on the information that are available for the management. For these things, the estimation, it depends. An estimation, it may requires revision. It may require many revisions if changes occurs regarding the circumstances. If changes occurs continuously regarding to their circumstances on which the estimate is based, for that the changes required, or as a result of new information, more experience or subsequent developments happens, or a change in the accounting estimate means difference arises between parameter estimated earlier and re-estimated during the current period, or actual results achieved during this period. So few examples on situation wherein accounting estimates or need cannot be given as follows. See, a company incurs expenditure of 10 lakh on development of patent. Now the company has to estimate that for how many years the patent would benefit the company, and this estimation should be based on the information that they have during this year. And a company dealing in long-term construction contracts use percentage of completion method for recognizing the revenue at the end of their accounting period. For recognizing the revenue, they use the percentage number. Next, under this method, the company has to make provisions for unseen contingency, which can take place while executing the remaining portion of the contract. Since provision for unseen contingents requires some of the estimation, there may be excess or short provisions which is to be adjusted in the period when it is recognized. So company has to provide for taxes. Which is also based on estimation, as there can be some interpretational differences on accounting, of which tax authority may either accept the expenditure or refuse it. So this will ultimately lead to different tax liabilities. So okay friends, this was your chapter. So here you can see, here you have some of the questions of your chapter accounting as a measurement discipline, valuation principles, and accounting estimates. Here you have some of the questions in relating to your fifth chapter, So okay friends, so this was your the fifth chapter, that is the accounting as a measurement discipline, valuation principles, accounting estimates. Here you learned about, so till now what you learned, let us see a quick recap. So here you learned about the measurement, meaning of measurement and its basic elements. You learned about for accounting is a measurement discipline if it is considered from the standpoint of the basic elements of measurement, and you have distinguished between the valuation measurement with valuation. You have learned the different measurement bases, namely historical cost, realizable cost, present value. This you learned, and you also understand the measurement basis which can give objective valuation to the transaction and event, and you also learned the accounting system that are used for historical cost as measurement base, although in some cases other measurement bases are also used. These all you learn, the things you learned in your fifth chapter, accounting as a measurement discipline, valuation principles, and accounting estimates. So okay friends, I think you understand about the what is measurement, valuation of principle, accounting estimate. So okay friends, I will see you in my next video explaining another chapter of chartered accounts. So if you understand this chapter, please give a like and comment me. If you does not understand any concept or how was my explanation, please give a comment, and subscribe my channel MN Coaching Center for more videos on your chartered to get more updates on more videos of your chartered account chapters. And my Instagram, follow my Instagram handle MN Coaching Center. There also you will get every update before the video. I will put the link, premieres videos. There I will put the link, and I will put so you may watch there. Also you will get update in Instagram also about the video, next video what it is about, which topic I am going to explain. So for that you can follow Instagram handle also. So okay friends, I will see you in my next video explain another chapter. Till then, take care, have a nice day, bye my dear friends.